The second learning objective is to use the payback and rate of return methods to make capital investment decisions. Payback is the length of time it takes to recover in net cash inflows the cost of the capital outlay. The payback model measures how quickly managers expect to recover their investment dollars. All else being equal, the shorter the payback period, the more attractive the asset. Computing the payback period depends on whether net cash inflows are equal each year or whether they differ over time. We consider each in turn. To compute the payback period when the investment has equal cash inflows, divide the amount invested by the expected annual cash inflow. The result will be the number of years the investment takes to pay for itself. If the investment has unequal cash flows, the payback period occurs when the cumulative total of the cash inflows equal the cost of the investment. The payback equation only works when net cash inflows are the same each period. When periodic cash flows are unequal, you must total net cash inflows until the amount invested is recovered. The Z80 portal differs from the B2B portal and the website in two respects. One, it has unequal net cash flow during its life, and two, a $30,000 residual value at the end of its life. The Z80 portal will generate net cash inflows of $100,000 in year 1, $80,000 in year 2, $50,000 each in years 3 and 4, $40,000 each in years 5 and 6, and $30,000 in residual value when it's sold at the end of its life. This is shown in this exhibit, the payback schedule for these unequal annual net cash inflows. By the end of year 3, the company has recovered $230,000 of the $240,000 initially invested, so it is only $10,000 short of the payback. Because the expected net cash inflow in year 4 is $50,000, by the end of year 4, the company will have recovered more than the initial investment. Therefore, the payback period is somewhere between 3 and 4 years. A major criticism of the payback period is that it focuses only on time and not profitability. The payback period considers only those cash flows that occur during the payback period. This method ignores any cash flows that occur after the payback period. The key point is that the investment with the shortest payback period is best only if all other factors are the same. Therefore, managers use the payback method as a screening device to weed out investments that will take too long to recoup. They rarely use payback period as the sole method for deciding whether to invest in an asset. When using the payback period method, managers are guided by the decision rule shown here. Companies are in business to earn profits. One measure of profitability is the rate of return on an asset. The rate of return focuses on the operating income, not the net cash inflow as asset generates. The rate of return measures the average accounting rate of return over the asset's entire life. Let's look at the average annual operating income in the numerator first. The average annual operating income of an asset is simply the asset's total operating income over the course of its operating life divided by its lifespan, or number of years. Operating income is based on accrual accounting. Therefore, any non-cash expenses, such as depreciation expense, must be subtracted from the asset's net cash inflows to arrive at its operating income. Now let's look at the denominator of the rate of return. The average amount invested in an asset is its net book value at the beginning of the asset's useful life plus the net book value at the end of the asset's life divided by 2. Another way to say that is that the asset's cost plus the asset's residual value divided by 2. The net book value of the asset decreases each year because of annual depreciation. Calculating average annual operating income from an asset involves total net cash inflows during the operating life of the asset, $60,000 times 6 years, less total depreciation during operating life of the asset, that's the cost minus any salvage value, total operating income during the operating life of the asset, divided by asset's operating life in years. This equals the average annual operating income from an asset. In this case, calculate the rate of return as $20,000 divided by $240,000 plus 0. Then divide by 2 equaling $20,000 dividend by $120,000 equals 0.167 or 16.7%. Companies that use the rate of return model set a minimum required rate of return. If Smart Touch requires a rate of return of at least 20%, then its managers would not approve an investment in the B2B portal. Accounting rate of return decision rule. Invest in capital assets. If the expected rate of return exceeds the required rate of return, then invest. If the expected rate of return is less than the required rate of return, do not invest. Short exercise 21.2 focuses on the payback period and rate of return methods to make capital investment decisions. Consider how Smith Valley Snow Park Lodge could use capital budgeting to decide whether the $13,500,000 Snow Park Lodge expansion would be a good investment. Assume Smith Valley's managers develop the following estimates concerning the expansion. Number of additional skiers, 117. Average number of days per year, 142. Useful life of the expansion in years is 10. Average cash spent by each skier per day, 236. Average variable cost of serving each skier per day, 76. Cost of expansion, $13,500,000, and the discount rate is 10%. Assume that Smith Valley uses the straight-line depreciation method and expects the lodge expansion to have a residual value of $1 million at the end of its life. First thing, compute the average annual net cash inflow from the expansion. So we have average cash received from the skier per day, that's 236. Average variable cost of serving each skier per day, that's a cash outflow of 76. The average net cash inflow per skier per day is 160. Number of additional skiers, 117. Average net cash flow per day, $18,720. Number of ski days per year, 142. Average annual net cash flow per year, $2,658,240. Second, compute the average annual operating income from the expansion. Average annual net cash inflow minus depreciation, $2,658,240 minus $1,250,000. This equals $1,408,240. Compute the payback period for the expansion project. Payback period, the formula, equals amount invested divided by the expected annual net cash inflow. So 13,500,000 divided by 2658,240 is 5.1 years, rounded to 1 decimal place. Now we need to calculate the rate of return. The rate of return equals average annual operating income from the investment divided by the average amount invested.